Hey folks, welcome back to the channel. It's Liquid here. And you may have heard that last week the Bank of Canada increased interest rates again by 0.25% to 5%, which is the highest it's been in over 2 decades. But is this going to be the final time that interest rates are going up before we see them come down? I think it is. I think it's similar to what happened in 2006 and 7, where interest rates went up, paused a bit, went up a little bit again, and then there was a dramatic cut. So this time it went up, paused up a little bit, and if inflation continues to go down, then I think this is the highest that we're going to see in this cycle. The reason they were increasing rates was because of inflation, but if we look at CPI for the latest month in May, which is the latest data we have, it's down to 3.4%, and the trend is heading lower. And if we look at core inflation, which takes out food and energy, we can see it's at 3.7%, which is also below the 5% Bank of Canada interest rate. So if the bank's rate is at 5% and inflation is below that, then it's only a matter of time before inflation goes back down to the 2% inflation target. Now the question is, how quickly does the Bank of Canada want inflation to go back down? If they want to hit their 2% target by the end of this year, then they may still want to hike rates 1 or 2 more times before the end of this year to really hammer down that CPI even more so that it gets closer to the 2% target. However, the risk of doing that is that inflation drops too quickly and then the economy slows down and we head into a recession. Because the economy is already not growing by very much. The first quarter of this year, which is the latest data we have, the economy grew by 0.8%. So that's less than 1% during the first quarter on an annualized basis. And the quarter before that, the economy literally grew at 0%. So there was no growth. Plus, all the interest rate hikes over the last year have started to affect consumers and how they spend money. Consumer debt is now at all-time highs, and people are finding it more difficult to pay back their loans, especially making their credit cards and car payments. According to the Globe and Mail, the delinquency rates for both credit cards and car loans are now above their pre-pandemic highs. So people aren't able to make their payments on these at the highest rate since before 2016, basically. Fortunately, mortgage payments are still okay, like people are still making those payments, but mortgage arrears are actually a lagging indicator, so that's not something you want to look at if you want to know how things are going to go into the future. Mortgage delinquencies typically follow the path of other types of debt. So if more and more people stop paying their other loans, then mortgages will eventually catch up. Because of course, if you're going to miss a payment on your debt obligations, the last thing you want to be delinquent on is your mortgage. Like car loans, the worst that can happen is they come and repossess your car. But that's a better position to be in than if a bank comes and try to take your home away. And the United States is in trouble as well because their federal deficit nearly tripled, according to NPR. And of course, if the government spends way more money than they're taking in, then they have to make up that difference through creating more debt. And if interest rates are higher, then it's going to be more problematic to service those debts. Why did the deficit grow so much? From the US Treasury website, we can see that last year, for the month of June, the US government took in about $460 billion in tax receipts. But if we look at the most recent data for June of 2023, that's dropped down to $418 billion. Right, so last year 460, this year 418. And a big reason for that is individual income taxes. So for last year, people paid $200 billion in the month of June for 2022. And this year, instead of $200 billion, it's $149 billion. So that's like a 25% decline. So this is a pretty big deal. And if you look at the current fiscal year to date, let's look at last year. Basically through the first half of the year to date, individual income tax earned was $2.1 trillion. Because all of these numbers are in millions, so you just have to add 6 more zeros to them. So 2.1 trillion year to date last year. And in this year, June 2023, year to date, is only 1.6 trillion. So 2.1, 1.6. That is a huge decline. Basically, what that means is individual Americans have so far paid the government 20% less income tax so far this year than the same period last year. That goes to show that the stimulus money is running out. People are buying fewer things. Businesses are hiring less. That's why they're paying less wages. And then so people are paying less taxes. And this slowdown in the West is also affecting large exporting players in the East. This is why China's economy has slowed in May. And instead of, hiking interest rates and tightening monetary policy, the Chinese government has actually been increasing stimulus for the past few months. But I don't know how effective that extra stimulus money is going to be because the problem is that exports are falling in China, right? So that means people in other countries that are buying things from China, they're not placing their orders. So even if the Chinese government just like gives out free money or gives out loans to these companies and say, hey, produce more things, we'll give you the money to do it. It's not going to work if those companies don't have clients or customers to sell their products to, right? Like if I'm making toys and my orders drop from 100 units last year to 80 units this year, like what's the point of making more toys if I know they're just going to sit on the shelf, collect dust, and get marked down in price later on? So the slowdown in China, I don't think it's going to be solved by like internally because they depend on other countries. So if demand from other countries like the US and Canada and other places are down, then that's obviously going to affect Chinese producers. So with the two largest economies in the world slowing down and the risk of more people defaulting on their loans within Canada, I don't think the Bank of Canada is going to increase rates again in September or later this year. The only caveat where they might have a reason to increase again is if we see inflation rate pick back up. So if this goes from like 3.4 in May to 3.5 or 3.6 or over in June, then maybe. Same thing with core inflation. If this starts to go up instead of going down, then another 25 basis point increase might be on the table. But for now, as long as inflation goes down, I don't see the Bank of Canada increasing rates again this year. And even if they do, I think it will be short lived, like one of these previous instances where it soon dropped afterwards. So let's see what happens. Thanks a lot for watching, and good luck with your finances.